I've been alive, in one form or another, for over 300 years. I helped write the Declaration of Independence. I negotiated the Treaty of Paris. I've seen a lot. But I just read California's 2026 tax proposal, and I genuinely don't know where to start. Here's the question at the center of this whole thing, and I need you to really sit with it for a second. Can a state legally charge you taxes after you've already left that state? Not while you live there, not when you move out. After. Years after. Your stuff is packed, your U-Haul is gone, you've got a new address, new driver's license, new life, and California is still sending you a bill. I'm Benjamin Franklin. This is Finance with Franklin, and today we are going line by line through the most controversial state tax law in modern American history. Because whether you live in California, left California, or are thinking about leaving California, this affects you directly, right now.
Last week on Finance with Franklin, we broke down the Tennessee tax, 9.25% sales tax, the highest major metro rate in the entire country on groceries, hidden in plain sight under 3 magic words: no income tax. If you missed that video, go back and watch it. It's wild. But here's the thing about every tax trap we've covered so far. They were all passive, meaning the state didn't come looking for you. The tax just existed and you walked into it. California's exit tax is different. California is not waiting for you to walk into it. California is coming to find you after you left with a calculator. That is a fundamentally different kind of aggressive, and it deserves a full breakdown. So let's get into it.
First things first, I know what half of you are already thinking. Franklin, this has to be unconstitutional. You can't just tax people who don't live in your state anymore. And that's a completely reasonable reaction. Here's why California thinks it can. The legal theory is based on something called source-based taxation. The idea is simple. Income that was earned in California, or wealth that was built in California, belongs in part to California, even if you move. Think about it this way. If you spent 15 years working at a tech company in San Francisco, accumulating stock options that are now worth $3 million, California argues that those options were earned inside California's borders. So when you cash them out in Texas or Florida or Nevada, California still wants its percentage. Because in their view, you didn't earn that in Texas. You earned it in California. You just collected it somewhere else. Now, courts have allowed versions of this argument before. The Supreme Court has ruled that states can tax income earned within their borders, even if the taxpayer has since moved. That legal precedent exists. What California is doing in 2026 is pushing that precedent further than any state has ever pushed it. And the question of whether it holds up in court is genuinely not settled yet. Which means right now, people are caught in the middle, between a bill they may legally owe and a legal fight that hasn't been decided.
All right, this is the part that I need you to pay very close attention to, because this is the part that most news coverage gets wrong, or just skips over entirely. California's proposed wealth tax doesn't just go after income, it goes after unrealized gains. You need to understand what that means, because it's not how taxes have ever worked in American history. Unrealized gains are increases in the value of something you own but haven't sold yet. Say you bought Apple stock 10 years ago for $50,000. Today, it's worth $400,000. You haven't sold it. That $350,000 gain is unrealized. It's on paper. You haven't seen a dollar of actual cash from it. Under California's proposed framework, they want a percentage of that $350,000 every year, whether you sell or not. And if you moved out of California after acquiring those assets, they want to follow you. Let me make this even more concrete. You're a 38-year-old software engineer. You spent 12 years at a startup in San Jose. You left California in 2023. You moved to Austin, Texas. No income tax, fresh start. But you've got $800,000 in unvested stock options that you earned while working in California. Under the proposed California framework, when those options vest and you cash them out in Texas, California claims a portion based on the percentage of time you were a California resident while earning them. You are in Austin, your money is in a Texas bank account, and you are still negotiating with Sacramento. I want to be very precise here, because I don't do outrage for the sake of outrage on this channel. The outrage is earned. Taxing income that was earned in your state, even after someone leaves, has legal precedent. I don't love it, but the courts have allowed it. Taxing the increase in value of an asset that you own but have never sold on an annual basis on someone who no longer lives in your state, that is new territory. That is legally contested, and that is what California is attempting in 2026.
This is the part where I want you to drop something in the comments. Do you think a state should be able to tax wealth you haven't actually received yet? Yes? No? Or it depends, and tell me what it depends on. I want to know where y'all land on this, because this is a genuinely complicated question, and the comment section on this one is going to be interesting. Now, here's the part that people who moved out of California need to hear right now. Because this isn't even the proposed stuff. This is already the law. California has a rule that says to be considered a non-resident for tax purposes, you need to be physically outside of California for at least 546 days out of any 24-month period. 546 days. That's a year and a half that you have to prove you were gone. And California has an entire department, the Franchise Tax Board, whose job is specifically to audit people who claim they moved out. They check your credit card transactions, your phone location data, where your doctor is, where your kids go to school, where your car is registered. They have a checklist, a literal checklist of everything that can tie you back to California. And if you fail enough boxes, you still owe California income tax, even though you moved. People have moved to Nevada, to Texas, to Florida, genuinely left, and gotten a bill from California 2 years later because they flew back for Christmas or kept their gym membership in LA, where their dentist was still in San Diego. California does not let go easily. The exit tax takes that existing aggressiveness and turns it up to 11.
All right, I'm not going to leave you with just the outrage. That's not what this channel is. Here's what smart people are actually doing. Number 1, document everything if you're leaving California. The day you move, document it. Keep a daily log for the first 18 months, receipts from your new state, utility bills, lease agreements, doctor visits in the new state, everything that proves your life has genuinely moved. California puts the burden of proof on you, so build your case from day 1. Number 2, if you have unvested stock options or deferred compensation, talk to a tax attorney before you move, not after, before. The allocation of California's source income on equity compensation is genuinely complex. There are legal strategies for structuring your departure that can significantly reduce California's claim, but those strategies have to be set up in advance. Once you've moved and the options have vested, your options for fighting it are much more limited. Number 3, watch the legal challenges. The proposed wealth tax on unrealized gains is being challenged. Multiple constitutional law scholars have called it a likely Fourth Amendment and Commerce Clause violation. The California legislature knows this. It's partly why the full version hasn't been signed into law yet. But the underlying framework, aggressive residency audits, source-based income tracking, departure year clawbacks, those are already active. Don't wait for the courts to sort it out. Plan as if it's real, because the parts that already exist absolutely are.
Okay, I need the comment section to go absolutely crazy on this one. First, if you left California or you're thinking about leaving, drop your situation below. Did you know about the 546-day rule? Are you worried about the exit tax affecting your equity or investments? Real talk only. This community shares real information. Second, if you think this is government overreach, flat out unconstitutional, or honestly just wild, hit the like button. Not for the algorithm, for the message. Because the more this video reaches people, the more people make informed decisions before they get blindsided. Third, and this is the one I really mean, if you know somebody in California who's been talking about moving to Texas, to Florida, to Nevada, send them this video right now, before they move, because the time to understand the exit tax is before you pack the boxes, not when the Franchise Tax Board letter arrives 2 years later. That's not fear-mongering. That's just being the friend who actually looked it up.
Here's the line I want you to walk away with today.
Every state has a value proposition. California's used to be great weather, world-class opportunity, and a tax bill worth paying. For a lot of people, that trade still works. Silicon Valley is still Silicon Valley. The entertainment industry is still in LA. If your income and career are tied to California, the math might still make sense for you. But if you're leaving, or thinking about leaving, California is not going to make it easy, and they are not going to say goodbye quietly. Know the rules, build your paper trail, get a tax attorney before you make the move. And don't let a letter from the franchise tax board 2 years later be the first time you heard about any of this. That's what Finance with Franklin is here for, the stuff that doesn't make it into the moving company's welcome packet. Now, we've spent the last several weeks talking about where not to go and what to watch out for. Next week, we're switching it up. There is a region of New York State, not the city, not the suburbs, that wealthy investors are quietly calling the new New York. Upstate zip codes where land values are climbing, where Manhattan money is flowing in, and where regular people are still getting in at ground floor prices. We're identifying the exact zip codes, the exact investment thesis, and the reason the people who know about this are not talking about it loudly. That's next week. Subscribe so you don't miss it, because by the time it's mainstream news, the window will already be closing. I'm Benjamin Franklin, and this has been Finance with Franklin. See y'all next week.